Hi, today we will be talking about liquidity interest rate component, how to split them, what does it mean, why they are different. And also I would like to walk you through some examples and exercises, and please let me know in the comments what in your view the correct answer is. So we will have also some kind of exercises just to summarize that what we have seen until now is of good understanding. But before that, let's jump into the interest and liquidity component within the FTP framework. So we said, let's summarize what we have said previously, that FTP is basically composed of several components, but the most important are two. One is reflecting the reference rate, which could be, the risk-free rate, which is a swap rate, OIS swap curve. Especially because LIBOR is replaced now, and we don't have anymore the LIBOR curve. Therefore, it is not the best risk-free benchmark. So we are using now overnight index swaps, which is basically exchanging the SONIA for the fixed rate, SONIA compounding over the period, and 1 year, 2 year, 3 year, 6 months. That's all tenors are reflecting this risk-free curve, and this is what is the minimum the product has to pay for the interest rate risk hedging. Because this is exactly, imagine the asset is 5 years asset. Of course, for treasury, this asset is exposing the bank to the interest rate risk on the medium long end of the curve. Therefore, Treasury will be closing this exposure through the payer swap, 5-year payer swap. Of course, if you want to assume that Treasury will be closing the exposure over the whole time of the asset life, which is not always the case. And during the interest rate risk session, I will explain you this is basically discretionary within the appetite of the treasurer, to which extent the balance sheet will be hedged, of course, based on the metrics. So first task is to have to be compliant with the metrics, and only then Treasury can have this discretionary role. But this will be in the later stages. So now let's focus on the base curve. The base curve is telling you this is the minimum charge in terms of the risk profile of this product, because the interest rate risk has been transferred Treasury to Treasury. Treasury will be closing the exposure which is driven by this asset in the market through the payer swap, and therefore we are charging to the business unit the cost of hedging of this asset, which is based obviously on the swap curve in this case. So we are talking about reference rate. So reference rate is the component which is basically in charge to transfer correctly the full interest rate risk from the product to the central unit. But as we said previously, it's not enough, it's not sufficient. We also know that we are not paying into the market, deposit market or capital market, the risk-free price for our funding. Therefore, there is additional component which reflects the own riskiness of the bank, which is on the top of the base rate curve. And how we create it is the whole, procedure for the bank, very important one. You have to first set up the methodology. Based on this methodology, you will be creating the curve, which will be based on the specific construct which your bank has set up. However, each tenor has always this additional TLP on the top of the certain tenors of the base curve in order to reflect the credit worthiness of the bank itself. And as such, this will be the price which you will be paying for your, funding of 2 years, of 3 years, 5 years, and etc. So it's basically by each tenor you have the marginal cost of funding. Because why marginal? Because it's not average cost of funds. It is the cost of funding new 1 unit of the asset by your liability. So how much you have to pay by raising additional 1 unit of liability to fund your 1 unit of assets. And of course, this is quite approximate, because in reality, there is always some portion of equity, which is also funding the balance sheet. So we cannot assume that 100% of the liability is funding 100% of the asset. However, there is the adjustment, which I will show you in the later, by the end of the course, of the sessions, how to basically get it back, this credit, equity credit, and how it is all incorporated in the FTP framework. So basically, you see on this slide that you have the base curve. This is the lower curve. On the top of this, we have added the term liquidity premium, which, as we said, is reflecting the cost of funds in the liability market, so deposit market or capital market for particular tenor. So this is why you have, by each tenor, you have to construct this funding curve by each tenor. So each tenor reflects the specific funding cost and the consumption of particular tenor of liquidity across the bank. So if, for example, you are originating only 5 years asset, then you know that your tenor, liquidity tenor, which is the most important one for your balance sheet, is 5 years, because this is exactly for how long your asset is consumed. Then on the top of this, we already analyzed it, and we will come back to the indirect liquidity cost. But for now, let's stop here and let's go through the exercises. So the first exercise is, what is combined NIM, net interest margin, for the lending and liability businesses? So you have basically the FTP curve. You have the spread on the top of the FTP curve for asset, for loan. So you see that the all-in customer price for this loan is 6%. And you see that this particular 7-year tenor of the FTP curve is 4%. Now, this position is founded by liability with the shorter tenor. It is 1 year liability deposit in this particular case, where we are paying to the customer 2%. Meanwhile, the FTP for 1 year tenor is 3%. So now the question which has been asked is, what is combined NIM? So both for the asset side and for the liability side. So the answers are or A, or B, or C. And answer A is 2%, answer B is 1%, answer C is 3%. So now let me know in the comments what is, in your view, the correct answer. Is it A, B, or C? Again, you have loan spread, you have deposit spread, and you know that the business unit is generating the P&L for the bank. So assets are responsible for generating, assets business is generating for the loans, different kind of loans to the customers, and liability side is responsible for generating funding for the bank. And in this particular case, it is funding originated by, retail funding, SME funding, financial institution funding. However, this is where your P&L is generated. Again, there is the difference between the FTP curve and the cost on the liability side, which is paid to the customer. So remuneration for the customer. So this is exercise number 1. Let me know in the comment what is the answer. The exercise number 2, the question is, which of the below components is not FTP rate? Not FTP. Do you remember we have analyzed the building blocks for the FTP components, for the FTP rate, and we have identified what are the corresponding, building blocks for interest rate risk, for liquidity, and so on. And now the question is, what is not FTP rate? So number 1, expected losses. Number 2, product costs. Number 3, incentive premium. And the answer, which are potential answer to these questions, are A, B, and C. Answer A is telling you that only 1 and 2 is non-FTP rate. So 1 and 2. B is saying only number 2. So only product costs are non-FTP rate. And number C is telling you that 1, 2, and 3 is not FTP rate. So please let me know in the comment what is the correct answer in your view to this question. Okay, let's analyze example number 3, which is quite interesting one, because I'm going also to show you the split between the P&Ls under the central unit. And this is the main topic in this exercise, to allocate it correctly to the corresponding business unit. So we have asset, which is fixed rate loan with maturity, fixed rate, obviously. So at some maturity, the maturity here is 2018, December 31st, December 2018. Then the notional position of this loan is 100 units. It could be euro, USD, GBP, whatever. And FTP rate in this particular case is 2%. Customer rate in this particular example is 3.5. This is only illustrative. This is the example. Repayment type of this position is bullet. It means it does not have any amortization profile. It's bullet. Bullet means that there is no amortization profile of the loan itself. And the repricing tenor, as we know, repricing is different. It's not always the same like maturity of the position. So those two can be different. In this particular case, they are not different, they are the same. So repricing profile of this asset is exactly the same as the maturity of the asset. And the reason for this, because it's the fixed rate loan with bullet maturity. So 100 notional. And this position is founded by the floating rate note with quarterly repricing. So we have 3 months repricing and 100 notional. The repayment type of this position is bullet. We don't have any amortization profile. And next capital payment date, so the one when it's maturing, is 30th June 2018. Meanwhile, the repricing date is a bit earlier. It's 3 months earlier. It's on March 31st of March 2018. Again, FTP rate is 1%, customer rate is 0.5%. So how we can design the split and what we want to understand, the question is in this exercise is, what is the NIM in business units? So what's the P&L in the business units and in ILM, in the central unit, having those data. So we need to design it correctly under the central model. Okay, so on the left-hand side, we have the asset center, and we know that we have 1 year loan, 3.5%, which is funded by liability. Liability has 6-month tenor. So we are running the maturity transformation because we are funding longer term asset with shorter term liability. So we have 1 year against 6 months. Now, we know that for given that the loan is consuming liquidity for 1 year, it has to pay FTP rate to the asset, to the central unit for 1 year funding. So the FTP, 1 year FTP. And in this particular example, we know that FTP was 2% because it was specified on the previous slide. Therefore, we know that the position here is matched. There is no risk at the asset side, and the lending spread is 1.5. So the risk has been charged through the FTP rate. Treasury ILM central unit is providing funding for this position, and at the asset center, everything is closed. Then when we look at the liability center, the situation is slightly different because this position is shorter. The cost to the remuneration or customer rate to the customer is 0.5%, the tenor 6 months, and we are receiving 6-month funding. Treasury is receiving 6 months customer funding, retail or SME, and remunerate the liability center for this funding 6-month FTP rate. So in this particular example, we know from the previous slide, the rate is 1%. Therefore, the difference between 1% and 0.5% is the deposit spread. So the deposit liability center P&L. So it is 50 basis points. The risk, again, has been transferred from the liability center to the central unit. And at the central unit, you see that we are running, as I said, the maturity transformation. My apologies, here should be 1 year rather than 2 years. So this is error because the position is for 1 year on the asset side. The difference, but the FTP rate is correct. So 2% on the asset side, 1% on the liability side. There is positive ILM spread of 1%, driven by the difference between 2% and 1%. So Treasury is running maturity transformation, is running the IRBB exposure, which has to be hedged, and each unit has its P&L booked. For the asset side, you have 1.5, deposit side is 0.5, and ILM spread is 1%. Without FTP, we wouldn't be able to see from where this P&L is coming. Because if you don't have FTP, this is not possible. You see only the all-in between 3.5 minus 0.5, so 3%, but you don't know how this 3% is allocated. And here you see that 1.5 plus 0.5 plus 1% is exactly your NIM at the bank level. However, here it is spread, so you see exactly what is driving what. Okay. Here I would like to show you exactly how the FTP is splitting at the ILM system level the different components which we were talking about during the previous session. So here exactly is the picture how ILM system is calculating and splitting the different sensitivities. And for Treasury, it is important to know what is each component which comes from the FTP rate, because you see what component is driving what exposure, and you have also calculate the sensitivity which is coming from those exposures. So I appreciate this slide looks a bit busy, but at the end it's quite straightforward. So let's go through it in detail, and I'm sure after the explanation or walkthrough, you will agree with me that it is quite straightforward. However, at the first look, it could look quite busy. So let's have a look at the same position which we have analyzed on the previous slides. So we have this 100 unit of asset with a longer maturity in comparison to the maturity of the liability. So liability is shorter. And you see that we have two kind of profiles, which is for asset and for the liability. So first of all, the notional is 100, and liquidity runoff is exactly where it is maturing, where the position is maturing. We said it is bullet position, therefore, there is no amortization profile. So here you don't see indeed this amortization profile. There is no amortization profile. And repricing of this asset is exactly the same, like its liquidity runoff. The only reason for this is because it is the fixed rate asset with the same repricing profile and liquidity profile, because it is bullet. So exactly when it matures, it is repricing. So this is shown here. Two different profiles, liquidity profile and repricing profile of the asset side. This is funded by the liability. Liability has slightly shorter tenor, and you can see here on the liquidity runoff that the liability profile is shorter, because at some point on this particular example, on July 2018, this position disappears, which means it matures. So you have here the liquidity risk exposure, because you have to refinance this liability, roll it over, replace it, if you want to have this asset funded, of course, because you need to repay liability, but your asset is still not coming under maturity. So this position is maturing before the asset, therefore you have exposure to the liquidity risk. Let's have a look at the repricing tenor of this position. Again, it is even shorter than the liability, than the maturity profile, because of its more frequent repricing. So we said this position is repricing on the quarterly basis. So every 3 months, there is the interest rate risk coming from this position, because the liability has to be repriced. So the position is resetting its rate. Therefore, there is the interest rate risk exposure. So until March, it's still fixed, but then you are running the interest rate risk exposure, because you don't know what will be the new rate at which this position will refix. And this is why we are showing here that we don't know what will be, this position. Basically, if you are talking about runoff, we are talking about runoff. We are not talking about the constant balance sheet. or balance sheet in growth. We are talking about runoff, which means we are showing this particular one position, and this is how you can interrogate the ILM system to provide you the view of the balance sheet. So the view could be or constant, when you know the position which is exactly maturing or repricing will be replaced by the same exactly by the item with the same exactly characteristics, and this is what means constant balance sheet. Or you have the balance sheet with growth, when you are also assuming the new production, the new business production. So this situation is runoff, so it's maturing. We are not showing any replacement of this position. This is why you see zeros here. But we want to understand what is the risk which this position is driving for your balance sheet and for your P&L. So again, the ILM system is splitting you in two components. You have the interest rate risk component, which you see here. And here I'm going to explain those numbers, exactly how they were calculated. And then you have the liquidity component. And liquidity component is slightly, squeezed to the right, because of course it is happening later, and this exposure is happening a bit later and for the shorter period, because the liability is maturing a bit earlier than the asset. However, earlier, this is repricing earlier. The liability is repricing earlier than asset. This is why you see the interest rate risk position for longer. So the interest rate risk position is for longer. And this is very important concept when we go to the interest rate risk in the banking book explanation. You will see how crucial it is. And basically, in my view, understanding of this very simple concept is quite crucial for understanding of the interest rate risk in the banking book. So as I said, this is the projection of the position in runoff, and the asset is repricing later than liability. This is why you see those two different exposures positioned differently. Very important point. Okay, so what is open interest rate risk position? Open interest rate risk position is your gap, is exactly your gap, or liquidity gap. In this particular situation, we are talking about the interest rate risk position. So it is your interest rate risk gap. So the difference between the outstanding of asset and outstanding of liabilities in the certain time bucket. And this is how you come up with this position, given that you are missing the liability. This position is driven by the liability side. So you have this negative 100, because it's your liability which is missing at this particular point. Yeah. And this is what you see here. And then your bucket exposure is calculated as notional of this position, or the net gap position multiplied by the length of the time bucket. So if you calculate, expressed here, it is expressed in years. So in days, sorry, it is days, the bucket term in days divided by 365, and this is how it was calculated. You will see that bucket exposure is different for each time bucket, except those here. It's driven by the different, length of the time bucket. So how many days it is 31 or 30 days. Each time bucket is how long is it. And then the exposure, the sensitivity is telling you how risky is this position. So the magnitude of the risk position by time bucket, and the overall sensitivity will be the summation of the time bucket sensitivities. So in this particular case, if you apply the shock, you see this 20 basis point. So on the risk-free parameters, we have applied 20 basis point shock. On the liquidity spread, we are applying 60 basis point shock, but exactly the position is calculated with the same equation which I've just explained. So this number is calculated multiplication of 20 basis points, so the shock multiplied by bucket exposure. So if you multiply this bucket exposure by 20 basis points, this is what you get. And you will see that when you calculate some those time buckets, you will get one number which is different for the liquidity, and you see that it's much higher for the interest rate risk component. And why it is higher? It is intuitive, because as we said, it is coming earlier and lasting for longer. So the risk position is materializing earlier and last for longer. This is why if you sum up those sensitivities and compare to the sensitivities coming from the liquidity position, then you have the lower number if you talk about the liquidity. So this is quite important concept, and FTP allows you exactly this. So ILM system will split for you those positions, so interest rate risk position and liquidity position, and you will understand what is driven by each risk component. So sometimes Treasury has those books allocated. So you have the liquidity book with the P&L coming from the liquidity risk management, and you have the interest rate risk book, which is showing your P&L driven by management of the interest rate risk in the banking book.